All right, welcome everyone. So today we're going to do a deep dive into how corporations strategically manage their liabilities. Now, for all of you in business administration, getting a solid grip on this isn't just about passing an accounting class. Honestly, it's fundamental. It's about understanding how a company makes strategic decisions and really how it stays alive and thrives in the long run.
So, let's kick things off with a question that might seem a little backward at first. In our own lives, we're taught that debt is something to avoid, right? It's a risk. But in the corporate world, that's only half the story. The right kind of debt, what we call leverage, can be an incredibly powerful tool for growth. Think about it. If you can borrow money at, say, 5% interest and invest it in a project that earns a 10% return, you're making money on the bank's money. That's the core idea. And we're going to unpack exactly how that works today.
To really get our heads around this, I want you to completely reframe how you see liabilities. Don't think of them as just a long list of bills the company has to pay. Instead, I want you to picture a chief financial officer's toolkit. And inside this kit are all these different financial instruments, a short-term loan, a 30-year bond, you name it. Each tool has a specific purpose, a specific cost, and a specific risk. The science is knowing the numbers behind each tool. The art is knowing which tools to pull out and combine to perfectly match where the company is trying to go.
And that brings us right to the heart of the matter, this constant balancing act. The whole point is to use borrowed money, that leverage we talked about, to boost the returns for your shareholders. It's just like a lever in physics, right? A small force can move a huge object. Same idea here. A little bit of the company's own money can control a whole lot of assets. But you have to keep it balanced. Too much debt and the whole thing becomes fragile. A small dip in sales could be all it takes to tip the scales and send the company into a financial crisis.
Okay, before we go any further, let's make sure we're all on the same page with a precise definition. A liability is basically a company's financial obligation. It's money they owe because of something that happened in the past. Now, on the balance sheet, liabilities are creditors' claims on the company's assets. And here's a principle you absolutely have to understand. It's called the absolute priority rule. What it means is that creditors, the lenders, the suppliers, always get paid before the owners, the stockholders. If the company goes under, the creditors get first dibs. This rule is crucial because it makes lending less risky, which in turn makes it cheaper for all companies to borrow money.
So here's a common trap students fall into. They see a company with zero debt and think, wow, that's a super safe company. But in reality, it might just be a company that's playing it too safe. It could be missing out on huge opportunities for growth. The real goal of a smart CFO isn't to have zero debt. The goal is to find the optimal capital structure. That's the perfect mix of debt and equity that makes the company's overall cost of funding, what we call the weighted average cost of capital, or WACC, as low as possible. The cheaper your funding, the more value you can create. All right, so let's crack open that toolkit and look at the most basic tools inside. The first and most fundamental distinction you need to master is the difference between short-term and long-term liabilities. And this isn't just some random accounting rule. It reflects a really deep strategic choice about how you fund your business. As you can see here, the difference is pretty simple on the surface. Short-term stuff is due within a year, long-term stuff is due after a year. Short-term debt is for the day-to-day grind. Long-term debt is for the future. This points to a core idea in finance called the matching principle. It's simple. You match the lifespan of your funding to the lifespan of the asset you're buying. So you fund your inventory, which you'll sell soon, with a short-term loan. You fund a new factory, which will last for 30 years, with long-term debt. A classic and very dangerous mistake is to get this wrong. Imagine trying to pay for that 30-year factory with a loan that's due in 1 year. You'd be in a world of hurt.
Let's look a little closer at short-term debt. We're talking about things like accounts payable, which is just the money you owe your suppliers, or maybe a short-term bank loan to build up inventory before the holidays. This is all about managing your working capital. The goal here is liquidity, making sure you have enough cash on hand to pay your bills as they come due. And let me be super clear about this. Profitability is not the same as liquidity. You can have a company that's making tons of profitable sales on paper, but if your customers don't pay you fast enough, you won't have the cash to pay your own staff. That's a classic way for a profitable company to go bankrupt.
Now, on the other hand, we have long-term corporate bonds. These are for the big-ticket items, the game-changing investments. When a company wants to build a new factory, or buy another company, or fund a huge research project, it often issues bonds. It's essentially borrowing money from thousands of investors at once. In exchange, the company promises to pay regular interest, we call those coupon payments, for many years, and then pay the original amount back at the very end. This gives them the stable, long-term cash they need for those huge projects that will pay off over decades.
Okay, we've covered the basics. Now let's get into a more advanced tool in the kit. And this is one that trips a lot of people up, the deferred tax liability. But it's actually not that complicated once you understand one simple fact. The accounting rules for reporting to shareholders are different from the rules for filing your taxes with the government.
So, what is a deferred tax liability? Simply put, it's a tax bill that the company knows it has to pay, just not yet. It's going to be paid in some future year. And the key word here, the one I want you to underline in your notes, is temporary. This isn't about avoiding taxes forever. It's just a timing difference between when the accounting rules say you earned money and when the tax rules say you did. So on the balance sheet, it's listed as a liability because it's a future obligation that's going to require an outflow of cash.
Let's walk through exactly how this works, because it's actually pretty logical. The classic example is depreciation on a big piece of equipment. So, step 1. For the report you show to your shareholders, you might use straight-line depreciation. It's a nice, smooth, even expense every year. But step 2, for your tax return, the government often lets you use accelerated depreciation, which means you get a much bigger tax deduction in the first few years. That legally lowers your taxable income right now. Well, the tax you didn't pay in those early years, that's your deferred tax liability. That's step 3. You know you'll have to pay it later when the deductions get smaller. So it's a tool for managing when you pay your taxes.
Okay, so the best companies, they don't just take on debt and then forget about it. They are not passive. They are actively, constantly looking for ways to improve their debt portfolio. They're always looking for an edge. And these are what we're going to call power moves. These are the strategies that can unlock a ton of value for a company.
So this begs the question, right? Let's say a company took out a 10-year loan a few years ago at 6% interest. But now interest rates in the market have dropped to 4%. Is the company just stuck paying that higher rate for the next decade? Is there anything they can do? And the answer is a resounding yes.
The number one tool here is refinancing. And you probably already get this concept from things like a home mortgage or a car loan. It's the exact same idea. You take out a new loan at the current lower interest rate, and you use that money to immediately pay off the old expensive loan. For a big corporation, this usually means issuing new bonds at 4% to buy back and cancel the old bonds that were costing them 6%.
And what's so interesting about this is that refinancing isn't a one-trick pony. It's not just about getting a lower interest rate, even though that's the most common reason. A company might refinance to stretch out the repayment period. If cash is tight, pushing a big payment a few years down the road can be a lifesaver. Or, if a CFO thinks interest rates are about to go up, they might refinance from a variable rate loan into a fixed rate loan to lock in their costs. It's an incredibly flexible and powerful tool.
And we're not talking about pocket change here. The impact of these moves can be absolutely massive. For a big company with, say, $5 billion in debt, just lowering their average interest rate by 1%, that's $50 million in savings every single year. That money flows directly to the company's pre-tax profit.
So here's the bottom line. You have to see these interest savings for what they really are. They aren't just a number on an income statement. It's real cash. It's a direct injection of capital that the company can now use to grow. That's money for new research, for building a new plant, for hiring more people. It's literally fuel for the company's future.
Okay, let's zoom out for a second. We've talked about short-term debt, long-term bonds, deferred taxes, refinancing, all these different tools. But why? Why do we spend so much time analyzing all this? What's the end goal of managing liabilities so carefully?
This, right here, is the real lesson I want you to take with you into your careers. Mastering this toolkit is about building a company that's strong and resilient. It's about creating financial flexibility. A company with a strong balance sheet can survive a recession when its competitors can't. It can jump on a great acquisition opportunity when others are too strapped for cash. It gives them the confidence to make those big, long-term bets that lead to real, sustainable growth. This is what separates the good companies from the truly great ones. So I'll leave you with this final thought. From now on, when you look at a balance sheet, I don't want you to just see a bunch of numbers. I want you to see a story, because that's what the liabilities section is. It's a story about the choices a company has made, and it's a clue about its ambitions for the future. As you go on from here, always ask yourself, when it's your turn to make these decisions, what kind of story are you going to tell?